Good evening, everyone. Welcome to this interview for the Center for Financial Markets at IMT Ghaziabad. My name is Ritika Mudgil.
And I'm Bhavika Chanda.
And we are first year PGDM Financial Management students here at IMT. It is my pleasure to introduce Mr. Arijeet Tarafdar, a seasoned professional in investment and portfolio management with over 8 years of experience. Currently serving as Senior Associate Vice President at Darashaw, Mr. Tarafdar has managed portfolio assets exceeding $1.5 billion for institutional clients, including retirement and treasury funds. He has played a pivotal role in developing the firm's equity solutions vertical and expanding its wealth management offerings for high net worth individuals. Mr. Tarafdar is an alumnus of IMT Ghaziabad, where he completed his MBA. He also holds a bachelor's degree in information technology from the University of Pune. His professional journey also includes a stint at JP Morgan Asset Management. Mr. Tarafdar is recognized for his expertise in investment advisory, business development, and finance. So we are thrilled to have him joining us online today and look forward to hearing his insights. Thank you so much again, sir, for being a part of this interaction.
Yeah, thank you for having me, Ritika.
Yeah. So without any further delays, I'd like to proceed with the short interview that we have planned for today. So recently we have seen that there are reforms like T+1 settlement cycles, and there are new enhancements in regulations like SEBI coming and disclosures. And record-breaking IPO of LIC in 2022 showcased robust investor interest. So having said all of this, I would like to know what's your perspective on the recent changes in India's capital markets. Like, how do you foresee the equity and bond markets evolving in the near future?
Yeah, so I think all of this has to be viewed from two perspectives. I think one part is how much of a free market do we operate in, and second is how much governance is too much governance, I guess. And at that front, I think SEBI's actions have been two-pronged, right? So one is, with settlement timelines, etc., that is ease of investing. So you get your settlement quicker than it was earlier, and that's a pro-investor move. Whereas even something as small as these bank nifty expiry options being regulated, that's something that you can look at as governance which has been taken forward with the view of protecting the investor, but doesn't allow the investor to access that choice, whether they want to access the bank nifty or not. So I think SEBI as a regulator is also looking at the market very in a manner which suggests that they want to be protective of the smaller investors, which is retail. Okay, and the data is very stark on that, right? So 93% of these retail traders lose money, so on and so forth. And sophisticated investors have been making money off retail. In terms of regulations in general, both SEBI and RBI, I'll bring the RBI here also because a lot of stock market movements have also to do with what the RBI is coming in with. They have been very cautious, okay? And that has worked well, especially in a time where such a black swan event like COVID happens. These restrictions have worked well from time to time. What changed during COVID was that a lot of retail investors did come into the marketplace, okay? Especially the stock market. We saw an immense inflow from retail investors, which meant that regular investment rationals often did not work because retail money was coming in so strongly. So does it mean that retail money today is not coming in? It is. It is coming in through different sources. It's coming in through SIPs. It's coming in through IPOs, etc. You mentioned LIC, but even this Bajaj Housing IPO got some 4 lakh crores of bids, which means there was 4 lakh crore of bidding or leverage money. It might be leverage money also. which is available for investments, right? So that's huge amount of liquidity. One of the things that SEBI also did not stop allowing banks from offering loans for IPOs. So essentially, you might, as an investor, say that this restricts my ability uh, to kind of make bets or take calls basis the information I have. I think SEBI looks at it from a point of view that they are artificially reducing your downside. Okay, and in an asset class that is dynamic, that has some amount of volatility associated with it, I think short term might be painful. I think long term it does have advantages from a protection point of view, from a investor protection point of view, and that's their intent. You would have to have a intent for a organization such as SEBI. So where do I see this going? I think the since the intent is clear, and since the movement has been towards that protectionist kind of regime, I think more of the same really. Even that's what I see with the RBI as well. So, for example, NBFCs, right? NBFCs are a big part of the listed space as well. So RBI came out with a circular a couple of months back saying that if you are a bank and you have an NBFC, you would have to reduce the overlapping customers or business segments that you have. Okay. Now, for some NBFCs, it might be 30-40% of their business. Short term, it will be very painful. Okay. But long term, what would happen is that the customers being pushed through to your NBFC vertical because they are subprime, that won't happen any further. Hopefully. I mean, people always find loopholes here and there, but hopefully that's the intent. So it seems like that intent would remain. It seems like retail investor protection remains key, and I mean there is no good or bad to it really. It's just the way it's going to go. And I mean, uh, does it affect the market? I think yeah. Again, short term it does. I mean, there is an impact to it. There is a liquidity impact. There is a psychological impact in terms of the calls that you are taking and the ability of the wider market to be able to take calls. And there is a short term impact to that, and but that is hard to model for. So whenever we look at the markets, also regulatory changes are the only thing perhaps you can't model for. Okay, because they are a surprise whenever they do come in. You hear murmurs here and there, but essentially, if you are asking me as an investor, should I gear my portfolio towards an impending regulatory change? You can't do it. Okay, because but you can do it, sit on cash, but I mean that's not an investing philosophy. So I mean you have the information you have today, you have to operate on it. Okay, but yes, investors huge liquidity driving events. On the other side, let's think about like are there any SEBI or RBI actions in the near term which might cause equity markets to boom, or there's some positive news around? I don't see anything happening. Uh, the budget might be the only one event between now and end of this quarter wherein we might see some positivity for equity markets and crude prices maybe here or there. But yeah, nothing else from the regulators at least.
Yes, I truly appreciate your views on this. Plus, with respect to India, we all anticipate a robust domestic demand when it comes to both equity and bond markets. So, it was a great value addition to hear your views on this. Sir, secondly, I'd like to know your views. Like we have seen recently that the global economic conditions plus the factors like Middle East conflict that is currently going on and the Ukraine war, deglobalization, and amidst other international dynamics. How do you think they affect India's macroeconomic stability and capital markets in particular? And how, in your view, should India navigate these external challenges?
Okay, so I think that's a fair question, and that's the question we uh, get a lot also. So there are parts to this. The first part, the last part of the question that you asked, that is foreign policy. So I'm not an
Yes.
expert. Okay. The first part of the question is perhaps I can shed some light on. India typically has been not a very globalized equity or debt market. Okay, in terms of, for example, in 2008, when the American subprime crisis happened, Greece defaulted. Okay, so that sort of connectivity typically doesn't operate in the Indian ecosystem. We are trying to build some of that connectivity through the Gift City initiative, wherein non-residents can place money, etc. But in general, we are, as a financial system, not very connected globally. Okay, so what happens is the advantage of that is that that has changed from 2008 to today. Today, we are maybe further along the road on that path than we were in 2008. In 2008, it helped us because apart from services and pharmaceutical companies which are dependent on an American ecosystem, we were insulated. That helped us there. Okay. Uh, Now today we'll have to go back a little bit because 2020 again, I come back to COVID because it was a black swan event, right? And countries across the world were trying to push growth, okay? And people did that in different ways. America did a direct benefit transfer. They transferred money into people's pockets that you have to spend, right? And that's the inflation that they are seeing till today. We took a more restrained approach that we'll, subsidize food for 80 crore people, but the funding that we'll do is for capex and not to your pockets. Okay, that allowed us to control the inflation quicker than America has been able to, or the West has been able to in general. Now, one of the key pieces that these geopolitical conflicts affect us is positively or negatively is crude. So that's a big part of our import basket. And for every dollar movement in crude, India's borrowing goes up by a substantial amount. So crude is important. I think from that perspective, the Russia sanctions have have been so neutral, I would say. There is some advantages that India can source some of that sanctioned Russian crude on the market, which is not dependent on the Western bloc. There have been some geopolitical downsides to doing that. That India has been questioned on a global forum, but it has been useful for us because we get subsidized crude for our members. Second is because of this sanctioned flow of crude, what has happened is crude in itself hasn't moved. So if you look at the crude data over the last, say, 8 quarters, it's been 2 years since the war kind of started, crude hasn't moved. It's like that 70, 85 range here or there, here or there. Okay. Uh, so crude, I think, is one of the pieces for this geopolitical puzzle that we have to keep under track because it's a core inflation item. Sorry, it's a CPI and WPI item, so it's an important part of the puzzle for us. On the geopolitical front, I mean, be it the Middle East, etc. So one is crude, and second is the strength of the dollar. I mean, on a macroeconomic perspective, I think strength of the dollar is the one of the other things which hits us hard, hits us well. So, for example, you must be seeing that the currency has been depreciating at quite a pace. Actually, I mean, the journey from 84 to 85.3 was not very long. And 85 is a psychological level also, which was not reached for quite some time. We had gotten close but moved up. So the strength of the dollar recently uh, has been uh, has been hurting us as a currency. Okay, and when I say hurting us, it's again it's a balance, right? It's good for some entities who export services, export goods. The cheaper your currency, the more your margins are. But it's also net negative because we have to purchase a lot in dollars. So the strength of the currency on dollar purchases also matter. So I mean, I don't know on the geopolitical front what we can do differently, etc. I think we have been doing decently well, so that they haven't really impacted us so much. But how the geopolitical conflicts impact us is through these couple of things, mainly crude and the strength of the dollar. And on that, when you talk about geopolitics in general, like for example, the expectation of a Trump presidency, even though that's not a geopolitical conflict, but that's a geopolitical event because a Trump presidency is ideally expected to be inflationary in nature, okay, for the American economy. And when any large Western economy, especially America, goes through an inflationary phase, what that means is in India, we are priming up for a rate cut cycle. But it's a possibility that a rate cut cycle might be much shallower than we expect because the inflation would be running high on the US. So the moment you cut rates here, what happens is your investments become less attractive compared to the American counterparts, money flows out. So again, that's a hit to your currency. So I mean, I think that's a large, rather political event, but it's a large geopolitical event for us also. That's a big macro event for us.
Yes,
Good
sir.
evening,
I
sir.
also absolutely align with your opinion on this matter. Plus, like geopolitical risks have been there since time immemorial. And like always, I strongly believe that India will this time as well, India will manage its way out very smartly.
Yeah, but at the start you said something, and I'll come back to it. When you said that domestic consumption has been strong, I think that's where we are seeing some pain developing in terms
Yeah,
of
yeah.
domestic consumption numbers. Be it the most common indicators are, automobile sales, automobile
Mm.
inventory is one. Uh, Credit growth in banking. If you see last couple of months, it's the first time in a while that credit growth has lagged behind deposit growth. Okay.
Yeah.
So earlier RBI
Mm.
was cautioning the banks that your deposit credit growth is going much faster than your deposit growth. You'll run out of funds basically because you have to manage deposits so that you will be able to lend it forward. So that's
Mm.
come down. Uh, so domestic consumption post a very strong recovery is seeing some moderation. I would say maybe pain is a very strong word, but we are seeing some moderation in domestic growth. But we can discuss that separately.
Yes, definitely.
So, I would like to ask a question. Like, as you have already mentioned, the active participation of retail investors in the capital market transactions. Even the NSE reported that 44% of the daily trades are done by retail investors actively through SIPs and equity investments. So, what is your take on the transforming market dynamics and the influence on liquidity trends?
From retail investors,
Yes, sir.
just a second, na, guys. I'm so sorry. I just told you the markets are still on. So, so I mean, as I was saying, so why did the retail money flow in? So look at some amount of background evidence for that. So this retail funding started during post-COVID, during COVID rather. What happened during COVID was that banks had slashed, central banks across the world slashed interest rates. Okay, they wanted to fund growth. One of the ways to do that is make your interest rates lower. The lower the interest rates, the more people spend. That's the idea, right? What that
Right,
also
sir.
means on the investment side is fixed income investments become less attractive. So if your broader interest rates go down, your FDs yield lower, your bonds yield lower, etc.
Mm.
So typically in those periods, money moves to risk capital, okay, risk assets such as equity, cryptocurrencies, etc. That was what happened in 2021-22. Money moved to risk assets like equities, cryptos, uh, angel VC funding, PE funding, etc. All the money moves there because money is searching for gains. Okay. Now, the staggering thing that has happened is that like you look at the DMAT data, right? I think it was some 4 crores at the start of 2020. It's 15 now in 4 years' time, right? 15 crores. It's a fourfold increase. Uh, I think at one point of time in the last year, the notional value of the options on the Nifty was higher than the notional value of the options on the S&P. Okay. So, so I mean, yeah, there is liquidity that has come in from retail, okay, and that liquidity is kind of has helped prop up the equity markets, but I don't think that's a make or break. I'll tell you why. Because it's large liquidity, yes, but it is not sticky money. Okay? Earlier, when FIIs used to pull out money, we always used to think about FII money as non-sticky money. They typically are with you for the good times, and whenever there are bad times, they flee fast. Okay. I think this phase of retail liquidity, some of it is not long-term money. It's short-term money anyway. Okay. So it is there. It is short-term money, and a lot of it is speculative money. It's also not money which will stay with you for a 5-7 year period. Uh, on the other side, if you look at the SIP data, for example, which typically you can categorize as sticky money in that sense, that SIP data is very strong. I think we are doing what 25,000 crores a month on SIP book, okay, as an industry. Um, so that's give or take 2.5 lakh crores a year. So that is there. Second, as we entered 23-24, what happened was that investment products on the fixed income side started getting more attractive. So today, if you look at a 5-year FD, for example, you're getting close to 8%. So that becomes more attractive. So that flow comes out. It stays within the capital market ecosystem, sure, but that liquidity has moved out. But and some of the pain that you're seeing in equities, I mean, we are 10% lower than where we were 3 months ago, right? We are 10% lower than the all-time high. Some of that has happened already. That liquidity moving out has affected us. But on the flip side, if you look at the first half of the year, FIs pulled out $10 billion in the first half of this year. They have only done that twice before this amount, which is 2008 and 2013 taper tantrum. We have corrected by 25-30% at that time. This time we didn't even correct by 5%. Okay. So this domestic flow of money, be it through SIPs, be it through insurance companies, be it through the EPFO, pension funds, provident funds, is managing to prop up or provide that liquidity which gets sucked out by somebody like the FIs. Okay, $10 billion is no joke. It's 80,000 crores in a matter of 3-4 months. Okay. So does that liquidity moving away hurt? It does hurt. It does hurt as it is a factor in the marketplace. But does it change the long-term kind of assessment of the market? Not really. It wasn't. It was speculative money, most of it in the first place.
Thank you, sir. Your views are truly appreciable, and how the retail participation has grown majorly in the COVID era, and how the liquidity is affected just for the short term and not for the long run because it is a speculative income.
Yeah.
So, with the growing emphasis on green investments and ESG investing in the capital market transactions, what is your take on these trends, and how do you believe it can be scaled further?
On ESG and sustainable, right?
Yes, sir.
Give me a moment. So sorry. Okay, sorry. So this is something which the world is, I think, debating with. Okay, so there was one direction which we were going through for a period of time. Okay, and that direction was that we're moving towards a platform where companies have to do good for the earth and be carbon neutral, compliant with green objectives, etc., etc. And in fact, some of the data is staggering on ESG driven initiatives. I think we in India have been late to catch up there, but abroad you see ESG funds, ESG schemes, ESG funds, like whole fund houses out of this concept. And I think some $1.5-2 trillion already being tapered towards initiatives which are green in nature. Uh, so, slightly maybe unpopular opinion, but I think for a period of time in between, the ability to engage capital in a way where it generates substantial returns and having being in line with ESG pillars, one took precedence over the other. Okay, so for example, ESG pillars took precedence over the other, and as money became more expensive, especially in the last 2 years, even funds quickly realized that at the end of the day, these are all investment vehicles. Okay, so you have to prioritize the primary objective, which is returns. Now, so that's one part of it. So if you want to look at a fund or look at an enterprise which is ESG compliant, it's still a investment vehicle, so that has to be a priority. But within the broader ecosystem, yes, it's a no-brainer. We have to move to an ecosystem which is kinder towards the physical ecosystem that we live in. It's common sense. There is no two ways to it. Okay, and to do that,
Absolutely, sir. We
Uh,
also saw that India saw 7.5 billion in green bond issuance. That reflected India's increased investor appetite for sustainable projects. We also
so that,
saw that
that's
SBS $650 million green bond, which helped for renewable energy projects. So we have seen a trend that investors are actually moving towards sustainable projects and are interested for giving back to the society in a way.
yeah. So I mean, see, all of these green bonds are issued by banks. They have an incentive to issue them because the government has given them the allowance to issue it. Uh, but the capital market or the companies in it are capitalistic in nature, right? So it is also a job to incentivize them to be ESG compliant. Today, for example, if you're a Indian mutual fund, I rarely see that ESG is a part of your selection metric. Okay. Because we are not evolved to that extent, right? But is this a path that we are taking? Absolutely. You have to. You have to incentivize your capital market agencies to put ESG at the forefront, or not at the forefront, but it should be an important parameter for any incremental investments that you make. Um, on the funding side of it, so for example, if you look at India's power generation structure, right? So I think over 40% of our power comes from renewable. Okay. So that's the sustainability bit. So when you talk about ESG investing is one bit, but the second part is to be sustainable as entities and seeing ROI for it. So when I look at companies such as which are into wind power or hydroelectric generation, etc. I think the incentives for them in the market in the foreseeable future are much higher. If you look at something like Tata Power, the way that share has done over the last 2 years, okay, it's built on that renewable story, okay. So that payout will happen in terms of setting up that capacity for renewable energy and building towards it. I think that payout will happen. It's happened in Western markets with electric vehicles and so on, and that should happen here as well. Uh, yeah, I think that's where we are. We are still behind the curve on that, but yes, building towards it.
Thank you, sir, for your insights.
Okay, so taking it forward from here,
Hmm.
sir, we are recently seeing a trend in the increasing use of technology and algorithmic trading in Indian capital markets. Like algo trading accounts for 50% of NSE's total volumes as per the 2023 data. So, what are your thoughts on this, and what do you think are the implications for market stability?
So, I mean, if there is any, so algorithmic trading in general, um, I think conceptually was a no-brainer always. If you had that computing power to do it, anybody would leverage that, right? Uh, is there a way or to control, restrict that? I don't think that should be the case. It's everywhere in the world. You see, quants, quant analysts rake in a lot of funds that way. Hedge funds across the world use algorithmic a lot. I think algorithmic is helpful to a retail investor in some sense because they use technical research to some extent, and if you are proficient in that, that is helpful. Uh, in terms of any long-term impacts, I mean, no, not really. I just what essentially happens is that when a particular level is reached, what I see, what is different today than maybe 10 years back when algorithmic trading was not a big part, the movements are much sharper. Okay. Because a lot of orders are clocked in very quickly when a particular level is hit, either on the downside or on the upside. So that's where I see a lot of uh, volatility that comes in with algo trades because a lot of systems put in their orders at the same point in time. But long time downside, I don't think this is something you can control. Okay, uh, it is cost efficient. It is executing faster than a entity, and typically institution use it more often to use to kind of uh, create their strategies. In fact, I mean, SEBI had published this framework, or proposed a framework, which they said that, you know, I'm sorry, my video is switched off. Just a second.
Yes, sir.
Yeah, sorry. So SEBI had published this framework that some 90% plus of stock market profits are through futures and options, and a lot of that is owing to this algorithmic trades. So yeah, I mean, I don't know of a long-term consequence of it as such, but I mean, it's a fact of the market that it's the way we are. What I have seen because of it, or what we assess that is because of algorithmic trading, is that at important market levels, the volatilities are much higher because, faster, uh, faster amount of order book are being put in.
Yes, sir. Like I also feel that your algo trading has basically enhanced market liquidity and price discovery, no doubt about that. But it also calls for stronger SEBI regulations because their reliability is still questionable, especially when it comes to high frequency trades, right?
So yeah, so you're talking about fat finger errors that
Yeah.
sometimes they might have a error, but to be honest, that's true with humans also. I mean, it's not as if we
Mm.
are immune to that. Uh, the challenge is that it might keep on trading, whereas a human might realize the mistake and stop. But I think anybody who is running an algo book would have an override option. But yes, that's true. I mean, wherever there is amount of binary system which goes through to do it, there might be one error which is repeated multiple times. That's true. That's
Mm.
possible. Yes.
Okay. So moving on from here, now I'm gonna go through a bit technical question at you, like something I am trying to figure out myself. So the question goes like, how has the shift from fixed to floating rate bonds impacted investor sentiment and liquidity in the Indian debt market?
So, I mean, typically fixed income was that, right? It's fixed. This sector of
Yeah.
the market is called fixed income. So, if you ask me that how much of the trading happens in fixed and floating would be a negligible percentage. Okay, I'll tell you
Mm.
why. Any asset that you buy, typically you buy it as a hedge for inflation. Okay.
Mm.
Uh, and there, what happens on shorter time frames, a floating rate bond might not hedge you. Okay. Whereas today, if I buy something at whatever, 8%, 10%, whatever, I am taking a call that 10% is the earning I am okay with for the foreseeable future, 5, 10 years, etc. Whereas floating rate, you can't make that assessment. It might be 4% next year, it might be 6%. Now, where is it an advantage is more on the ALM side. Okay, so for example, if you're if you're a financial entity and you're lending, say, a home loan, which is a floating rate bond, floating rate loan, okay, it makes sense for you to have the floating rate on the investment side also, because those are aligned. Okay, for an individual, what happens is that when when interest rates go lower, which is when floating rate bonds will also move lower, essentially on an investment side, it is net negative for that person, right? Because on his or her money is stuck there. Okay. So floating rate for, in my assessment, makes more sense for entities which are matching their asset liability from a tenure point of view and also interest rate point of view. You want to protect against interest rate movements. But whereas for an individual who is looking to lock in capital for a longer period of time, their fixed rate would make more sense in terms of the visibility that is offered there. Now, has in terms of the market in general, I mean, you can deep dive. I think a negligible percentage is floating rate, to be honest. Uh, Fixed rate, I mean, your central government borrows every week around 50,000 crores or so. They have a auction every Friday, and 50,000 crores of fixed bonds that are raised. States borrow, give or take, 10, 15,000, 20,000 a week again. Those are fixed. Most corporate bonds that we see, both PSU, private banks, NBFCs, fixed rate mostly. Okay. The government sometimes comes out with some bonds here or there which are tax free or floating. They are just one is that it makes it attractive for a certain class of investors, so you can price it a bit more competitively. And second, it allows for certain investors to match their ALM. They are lending to a borrower who is dependent on interest rates, so they are investing also in certain instrument like that.
Floating rate also increases uncertainty when there are rate hikes. So why do we
Yes.
still go for them?
So I think, yeah, that's what, right? So for example, if you want to think of it this way, that this is basically a security wherein you can plug in your money, and so that it gives you interest with varying. So if interest rates go up, you make more. Okay. If interest rates go down, you make less, right? So there are two parts to play this. One is that if you're buying floating rate bonds at the start of the interest hike cycle, there may be some upside for you over there. Okay. Because as interest rates go up, you earn a higher ROI. Uh, but essentially, I would see it as a mechanism wherein you want to be aligned to the whatever the interest rate in the economy is. That's about it. So, and for a floating rate bond to be successful, it's not as if a floating rate and a fixed rate will be priced similarly. A floating rate will have to give you a premium. Okay. So, for example, it might be a 10-year GSEC plus 200, 300 basis points for something like that. So, if the issuer also has to make it attractive for the lender to be able to invest in that. And if the premium is good enough and it aligns with my call or my requirements, yes, there is a subset of investors who may look to it, seeing that the if I buy a fixed income or a fixed rate bond of a same issuer, this might give me a higher ROI on that. That's about it.
Okay, so it's basically the timing of the market that we
It's
must take
timing and
into account.
also, yeah, it's the timing and also how you want to deploy the cash. Basically,
Okay.
that's also there, right?
Yes, sir. Got it.
I
So I
think,
would like to ask, how do you see the role of government securities in shaping India's debt market, particularly with the initiatives like Retail Direct Scheme?
yeah. So, if you look at the debt market in general, especially be it the government side, be it the corporate side. So, in India, the biggest borrower is the central government. Okay. States may become a close second, not close second. States as a whole may become a close second, but in general are much smaller. And third are corporates. Okay. So it is in all of our interest to have as deep a capital market as possible. Okay. And unfortunately, that's not been the case. In the corporate bond space, corporate bond markets haven't been that deep. So, having said that, though, if I ask you, or most laymen, okay, if I ask them that what is the investment that you can make which will give you a fixed return, most will say a fixed deposit. Okay, that's been the idea here. But today, if uh, we have an entity which wants to raise capital, you can raise capital in two ways, right? Equity and debt, simplistically. Okay, so it helps everyone in the ecosystem to have a deep enough debt market, a deep enough debt market which can absorb requirements of capital, so that at every point of time I don't have raise equity, which is much more expensive. Okay. So now the government, one borrows, like I said, on an average they borrow 50,000 crore a week, depending on what the deficit runs. Uh, the and the borrowing is lapped up. I mean, every week you see the auction is never as if they have to, they have offered some amount and that's not being taken. The idea is to give set of another set of investment options to the retail invest. That is one. Second, also is to activate that habit, right? So activate the habit as in deepen the bond space in general. So you start off with the government bonds, then move to state bonds, then corporate, so on and so forth. That get that going. But it's been a very institutionalized space in general. Bond markets in general, if you look at the trading data, barely any retail exposure. Okay, even now, even with all of what I said, okay, retail participation hasn't really gone up. Now, one of the culprits has also been that every bond has a face value. So bonds have typically had face values of 1 lakh, 10 lakh, 1 crore, which makes it a very institution-driven space. So today, from a safety perspective, if an NBFC raises a perpetual bond, the face value has to be 1 crore. Okay, that just picks out a lot of investors, right? Even a government bond, a central government bond, the minimum amount you can invest is 10,000. Okay, so if the face value is 100, but you need to buy 100 units. Okay, which is also not low. So, so the approach is commendable. I think there has to be that retail participation in the bond space as well. Not from a point of view of deepening. That's my interest that the bond market deepens. Also from a general investment option perspective, banks should be looked to as an option. Yes, they shouldn't be the only option for any sort of fixed income. Now, I shouldn't come across as saying that fixed income is the central government securities or bonds are as safe as fixed deposits, because when you do corporate bonds, you also encounter some default risk. Okay, so corporate bonds do come with some default risk. So there are checks and balances there, but that's the ROI that you get. That's the risk reward that you get out of it. Uh, essentially, uh, yeah, summarize, good move. I mean, there has to be that retail push that goes into government securities in general, but the end goal is to deepen that space, because government will get borrowing in any case, right? There'll always be people funding the government. The end goal is to deepen that corporate bond space so that companies can come in and raise capital this way instead of always having to raise equity.
Sure, sir. Thank you for your insights about the bond market and especially the Indian debt market with government securities. I would like to move towards the final question of, with India striving towards becoming $5 trillion economy, what structural reforms in the capital market do you think are the most critical for achieving this goal?
Okay. So I think a lot of things, right? I mean, yeah, that's a fair question. Uh, so you're not just talking about markets, right? You're talking about overall, as a country. So I might not be the subject matter expert on that, but some of the things I can see off the top of my head. One is that in terms of whatever we are offering, right? So let's do the export bit first. Like I think that's where uh, a lot of the growth in say China has come from the growth that they have seen on the export side. Okay, and what that does is that provides you a natural hedge to your domestic consumption. Okay, so in times when domestic consumption sort of moderates out, you still have that to bank on. We, on the other side, have been very dependent on domestic. Okay, which has served us well, and because domestic consumption in general has been strong, but you would rather have play both sides. And there I feel that value added engineering or research is something that we have to aim to do better. Okay, so uh, there has to be a Xiaomi from India, and we don't just be assemblers for an Apple or a Foxconn. Okay, so that value added engineering has to happen from here. Okay, so that's where you can make use of the demographic dividend that you have, right? So we talk about this demographic dividend, so many people in engineering colleges, so on and so forth. I mean, we have the kind of demographic strength to do this. It's just that there is some amount of pre conditioning that you have to do here. Preconditioning, I mean, be it R&D, be it that that essence of value engineering. It might take a year, it might take a couple of years, but that's where the incremental kind of delta should be. Okay, what we are doing great, but then what do we have to do for an Nvidia to come out of here, right? So I think that's where some of the pieces that we have done well recently is something like PLI. Okay, so we saw that growth in EV scooters, right? So that's where I think we are doing quite well. Uh, we are making products that can be exported to the world. Okay, we have done that uh, base case R&D on that. Okay, so that is something we can export to the world and it will be competitive. So I think that's one of the pieces that we have to look at more carefully in terms of as we look at that kind of $1 trillion outlook, what we need to do better in terms of that. Second is, you know, one of the key aspects for us has been this ease of doing business, right? I mean, that's one of the things that we have been talking about for some time now. So ease of doing business is a constant intent and focus. It has to be. I mean, we are doing better than we were, but it has to be something which is at the core of our focus. Okay, this how we operate, how we talk about encouraging entities to set up here. So something like the gift city, for example, which gives you some tax allowances if you, as a non-resident, invest through gift city, etc. Great. Okay. Make it simple. Make it as concise as possible. So I think that's one of the pieces that we need to keep on focusing. I think so. That's second. Third is, of course, making this taxation more transparent. Okay, so GST was one big part in that, and it has helped to an extent. But both, personal income tax and as well as GST, etc., make it more transparent, more accountable, because that's somewhere there are slippages which we see from time to time. So it's an absurd number, right? Some 3 to 5% of India is taxpayers. That's absurd. I mean, there is some slippage there. You would be sure. So that's untapped revenue that's going. Okay, and you need everything and more to do that. Fourth is, and this is something I have discussed on and off, and not because there are two ladies on the panel today. I think that participation of women in the workforce has to be taken more seriously. I think we are doing reasonably on that, but it that has to be a bigger incentivization. Like there are some initiatives like director level, you have to have two independent directors, two women, etc. But I think out of this whole demographic dividend, 50% has to be absolutely pushed and encouraged to, achieve that potential. I think women constructively being part of not that they aren't today. I mean, that push has to continue. And it has to be pushed further. I mean, there has to be more that has to be done along those lines that, you have the wherewithal that whatever education or whatever workforce you want to build up that has a substantial amount of women in it. That's very important from a broader growth stage. From a more finance driven piece, I think startups and fintech in general uh, have revolutionized a lot. And if you're a borrower, if I am lending someone money today as an entity, the amount of data I have at my disposal on that person's borrowing characteristics, be it CIBIL, be it their bank statements, all of it digital, I have softwares which can parse through the data and give me a whole profile. So to be a defaulter today versus being a defaulter 15 years ago was very different. Okay, 15 years ago, 1% NPA means, I mean, I can't believe I'm saying this, that meant lesser than a 1% NPA today. Because a 1% NPA today is in spite of all the data that you have, which means it's quite a willful defaulter. Okay. Whereas the 1% NPA 15 years back was more of a, you know, we did our due diligence, but then only to the extent of what was available, right? So today, fintechs have, unlocked and unlocked a level of consumption that was unheard of. Okay. And on the other side, that kind of employment that they bring in through, there is some amount of controversy on gig workers and contractual laborers, etc. But having said that, that's still employment. I mean, the kind of employment just, I mean, if I count four on my hands, Ola, Uber, and Swiggy, Zomato, the ambit of their workforce is a substantial amount. Okay, so that's something we have to keep on pushing. Uh, I think a lot of our problems need technological driven solutions. We have to encourage, the startup and the fintech ecosystem to make this whole goal more coherent. And and sixth is, coming back to the first point, there has to be a value added, approach to work in general. When I say value added, I mean uh, you have enough and more paper pushers, and you have enough and more who are doing what the world is doing and patenting it and doing it here. You have to have that value add. Okay, we are doing it in some pieces, PLI, etc. But there has to be more of a push for that. And sorry, I missed out on a big one is that, and one of the things we keep on missing, and since we are in Southeast Asia and the world is exploring tourism, I think that's one part we don't do too well on. Okay, some places do it exceptionally, but by and large we have ignored it because there has been enough smaller problems to solve maybe. But if you want to kind of have that 5 trillion goal, you have soft power, you have kind of places to see, and that potential for tourism, such a long coastline, all of that. I think we haven't utilized that potential well. I think tourism is another, because, for example, a restaurant in Mumbai, right, which sees, I think the last number was some 5 million tourists a year. Okay. So the restaurant is basically dependent on domestic consumption. I mean, people in Bombay only visiting that restaurant. But the moment tourists come into the picture, that's like leverage. They don't occupy essentially any resources for more than 5-10 days, but they churn business for you. Okay, so that impact on GDP has to be is important. So I think that's there. And I thought that was the last point. There is one last point. That last piece is private capex. So if you look at the numbers in terms of GDP, recently we had a downer on GDP, right? Last GDP number was lower, and experts pointed out that private government capex was lower this quarter because election season typically it's lower because files don't go through. There is a bit of inertia around elections. The other reason, which has been happening for the last 8 quarters or so, is private capex hasn't picked up. So you would see a lot of acquisitions in the cement space. You would see a lot of acquisitions here and there. So whatever incremental cash is there, it's being used to buy up entities which have capacity. So essentially, what you're doing, you're not adding any capacity. You're adding capacity to yourself, but not to the industry. Okay, so you're not doing greenfield expansions or anything. So private capex has to go up. So institutions, organizations have to be incentivized to use leverage, use debt, and push in brownfield, like state of the art, new capacity across the board. Okay, and that is another that push that we should have. Again, PLI was one part of that, but again, for larger conglomerates to do it more effectively is something we need to look at. I think it was a much longer answer than you're hoping for, but sorry, I mean, it's a topic we discuss on and off quite often.
Thank you, sir, for such a detailed analysis about the topic. Your points about adding value, the PLI status in India, and I would like to put up a point where you mentioned about the tourism in India. There's also initiative taken by our Prime Minister Narendra Modi encouraging destination weddings to be taken in India. Instead of ruling out a money out of India, it was emphasis that people do destination
Yeah.
weddings in India.
Yeah.
So we are extremely grateful, sir, for your time and the invaluable insights on India's macroeconomic trajectory and the evolving landscapes of capital markets. your perspectives on critical issues such as global economic challenges, the increasing role of retail investors, and the rise of green finance and transformative impact of technology have been truly enlightening.
So we are delighted to have had this opportunity to interact with you. It has really been an absolute privilege to learn from your expertise, and I'm confident that our audience will greatly benefit from your thoughtful analysis. We look forward to more such meaningful discussions in the future.
Yeah, sure. More than happy to engage whenever. Thank you.